It begins with silence. A room filled with screens, data streaming like rain on glass. Somewhere in that quiet storm of numbers, a man sits still, his eyes scanning what most people would call noise. But to him, it's music, patterns, hidden signals whispering where money will move before anyone else sees it. That man was Jim Simons, a former math professor who would go on to build the most successful hedge fund in history. While most traders on Wall Street trusted instinct, experience, and emotion, Simons had only one rule: trust the data, not your gut. He wasn't a banker. He wasn't a trader. In fact, he didn't even start his career in finance. He was a codebreaker, a mathematician at the Institute for Defense Analyses, working on Cold War encryption problems. Numbers were his language, and years later, those same numbers would turn him into one of the richest men alive. When Simons entered Wall Street in the late 1970s, he was an outsider. People laughed when he said he wanted to predict the market using math. One trader told him, "You can't model greed." Another said, "Markets are chaos. You can't quantify emotion." But Simons didn't argue. He just smiled and went back to his equations. He started a small firm in a quiet town called East Setauket, far from New York's glass towers. No shouting brokers, no chaos. Just silence, whiteboards, and computers. He called it Renaissance Technologies. Simons began gathering mathematicians, codebreakers, physicists, people who knew nothing about finance but everything about patterns. They didn't talk about stocks like everyone else. They talked about signals, noise, probabilities. They believed that behind every market move, no matter how random, there was a cause. And soon, they found one. At first, the models failed. They lost money. The algorithms misread trends. Simons doubted himself. Maybe the traders were right. Maybe markets were chaos. But then, one of his team members noticed something small, a repeating signal in foreign currency movements. It was weak, but consistent. They tested it again. It worked. Then again, still worked. That tiny anomaly became the seed of something much bigger. Simons refined the model. He built more data. By 1988, the Medallion Fund was born. In the beginning, it made a few million. By the early 90s, it made hundreds of millions, and then billions. The fund was so consistent, it became a myth. While the S&P 500 struggled to return 10% a year, Simons' fund averaged over 66% annually before fees for more than 2 decades. No fund in history had ever done that. Not Warren Buffett, not George Soros. No one. Employees inside Renaissance became millionaires. Traders outside tried to copy it. No one could. Because Simons' team wasn't just using data, they were living inside it. They had more than 300 PhDs working together: mathematicians, astronomers, linguists, even cryptographers. They used algorithms to find patterns in things humans couldn't even see, microsignals buried inside billions of data points. They didn't trade on news or feelings. They traded on math. Every trade was the result of a calculation, a probability. If the system said buy, they bought. If it said sell, they sold. No emotion, no gut, only data. The results? From 1993 to 2023, the Medallion Fund generated over $100 billion in profits, more than any other fund in history. It was so profitable that Renaissance had to close it to outside investors. Only employees could invest. Every dollar stayed inside, like a secret code too powerful to share. But success came with mystery. No one outside Renaissance knew exactly how it worked. There were rumors that it used satellite data, weather reports, even shipping patterns to predict markets. Some said he had built an AI long before the world even knew what AI was. In interviews, when journalists asked him how he did it, he'd just smile and say, "We found patterns that shouldn't be there, but they are." Wall Street couldn't believe it. A math professor had beaten the entire financial system using one simple philosophy: don't predict the market, decode it. His one rule, trust the data, not your gut, became legend. Because while the world reacted to emotion, his system reacted to numbers. And in the end, numbers won. By the mid-2000s, Jim Simons had stepped away from day-to-day trading, but the system he built still printed money, year after year, through crashes, recessions, and even COVID. When the world panicked, algorithms stayed calm. When humans lost control, data took over. And somewhere in Long Island, behind those secure doors, the same quiet hum of machines continues. Screens flash, models update, billions move without a single shout, without a single instinct. Just numbers, just data, just one rule. By the time the 2010s arrived, Jim Simons had already become a legend. Wall Street whispered his name, hedge funds studied his moves, and journalists tried in vain to unravel the secrets of Renaissance technologies. Yet, even with billions in profits, Simons remained quietly obsessed with one idea: data never lies, but humans do. The Medallion Fund had survived decades of economic upheaval, the dot-com bubble, 9/11, the 2008 financial crisis, even the COVID-19 shock. Every time the world panicked, the algorithms stayed calm, processing signals invisible to the human eye. While investors elsewhere lost fortunes chasing trends and headlines, Renaissance quietly compounded wealth, year after year, turning thousands of employees into millionaires. By now, AI was no longer a futuristic concept. It had entered Wall Street like a tidal wave. But Simons' team wasn't reacting, they were evolving. They began integrating machine learning models that could analyze trillions of data points daily, from economic reports and corporate filings to satellite images and shipping patterns. Every algorithm fed another, and each decision became more precise than any human mind could manage. And here lies the secret that makes this story more than just numbers. Simons wasn't trying to predict the market in the traditional sense. He was decoding the market's hidden patterns. Every spike, every drop, every anomaly told a story, and his algorithms were trained to understand it. This wasn't intuition. This was pure logic, magnified by computing power, immune to panic, greed, or bias. Wall Street took notice, of course. Hedge funds tried to replicate his strategy but failed. Why? Because Simons' method wasn't a formula, it was a living system. It learned, adapted, and evolved continuously. The edges it exploited were so fleeting and microscopic that human traders couldn't even perceive them before the window closed. By 2020, Renaissance had perfected a level of automation that most people could only dream of. The fund made billions in markets no one else even knew existed. Micro-trends across commodities, currencies, and obscure equities were all fair game. Simons' principle remained the same: trust the data, not the emotion. And while Wall Street analysts debated macroeconomic theories, Simons' team quietly amassed fortunes in the background. This raises a question that fascinates modern traders. How can ordinary investors learn from a mathematician who essentially built a market-predicting machine? The answer lies not in copying trades, the algorithms are too complex for outsiders, but in adopting his mindset. First, discipline is everything. Simons never made a decision based on fear or hype. Modern traders can emulate this by sticking to rules-based strategies instead of impulsive trades. Second, data is your ally. Even small investors have access to more information than traders had 40 years ago. Charts, historical performance, and AI-driven analytics can reveal trends that intuition alone misses. And finally, adaptation is key. Markets change, and Simons' systems thrived because they evolved with the market. Stubborn strategies die when the environment shifts. But let's be clear, replicating Renaissance is impossible. The fund's edge wasn't just technology, it was people who could understand complex patterns and translate them into code. Ordinary investors won't have access to terabytes of proprietary data or PhD mathematicians on staff, yet the principles, discipline, data-driven decisions, and adaptability are universal. There's another lesson embedded in Simons' story that is often overlooked: risk management. While the profits are staggering, billions in annual gains, the system is built to limit catastrophic losses. Algorithms are designed to stop trades when probabilities turn against them, ensuring the fund survives even when markets behave unpredictably.
It's a quiet, invisible safety net, the kind most human traders ignore in their pursuit of excitement. And this is where the story becomes even more relevant for 2025 and beyond. The rise of AI trading platforms, machine learning, and algorithmic strategies for retail investors means that ordinary people can now access some of the tools that were once exclusive to Renaissance. Apps and software can analyze patterns, track volatility, and even suggest trades. Though without the sheer sophistication of Simon's models, the results will vary. The principle remains: data over emotion, rules over impulses. Simon's legacy is also a cautionary tale. Many investors see AI and assume it guarantees profits. They forget the discipline and rigorous testing behind it. Algorithms can amplify gains, but they can also amplify mistakes if applied without strategy or risk controls. The Medallion Fund thrived because it married human intellect with machine precision. A tool alone is not enough. It must be guided by insight and structure. Even today, Simon's remains active behind the scenes, refining strategies, supporting research, and mentoring new minds. He has donated billions to science, education, and public causes, quietly reinforcing the idea that understanding patterns, whether in markets or society, is the key to long-term success. The story of Jim Simons is a testament to what happens when logic outpaces intuition, when discipline outpaces emotion, and when one simple rule, trust the data, becomes a superpower. It's a story of wealth, yes, but also of vision, patience, and the courage to follow truth where others fear to look. So, what can today's traders take away? Focus on data. Let numbers guide your decisions, not headlines or hype. Stay disciplined. Avoid emotional trades and impulsive reactions. Adapt constantly. Markets evolve, strategies must too. Respect risk. Profits mean nothing without protecting capital. The man who beat Wall Street didn't do it by luck, he didn't do it by chance. He did it by seeing patterns where others saw chaos, trusting logic where others trusted instincts, and building systems that could outthink humans at their own game. And while no one will ever fully replicate Jim Simons, his story offers a blueprint, a single guiding principle that can transform the way investors think about money, markets, and themselves. Because at the end of the day, whether it's 1987, 2025, or decades into the future, markets obey patterns, not panic. And those who understand them will always have the edge.